Hi guys, I wanted to make one last short video before your exam on Friday. And this is, I wanted to cover question 5 in the 2022 paper that we've been going through. It's the only question in this paper that's different to any of the other questions we've gone through in the 2018 and 2020 papers. So it is a question that's in your textbooks, but I thought I'd go through it on the screen just so that you guys can see the thinking that you've got to follow behind doing a question like this. Go here to the paper and how you should approach it and how the workings, the method, if you want, behind the workings. Okay, so let's have a look at it. It was a 30-mark question. Some of this question was theory, so not all of the 30 marks is calculations. But let's just have a look at it. You probably, if you've been going through your textbook, which hopefully you have been using as your chief source of revision, you'll recognize this question. So you are considering investing in Olympian Limited, a company that is listed on the JSE. You've extracted the following information relating to the company for the year. So then we've got a bunch of information here. So let's just go and have a look what they want us to do before we read any more of that. Don't forget to always look at the bottom if there's any more additional information that they've given you that's going to be relevant to whatever it is that they've asked us to calculate. So here they've said, calculate the value of Olympian Limited using the following business valuation models, the PE ratio and the dividend growth model. So two different business valuation models they want us to use to see what value we would come up with. One thing again, to show you how you must read these questions very carefully. Take note, they said calculate the value of Olympian Limited, which means they want the value of the company as a whole, not just the value of one share. Okay, that's what this wording means. They didn't say calculate the what price should the shares be trading at. They said calculate the value of the company. So in other words, if you were a person and you were an investor and you were perhaps considering purchasing this company, you would want to know what total amount you need to be able to offer the owners of the company or the shareholders as a whole, so that you knew what the company as a whole was worth as a valuation for the company. And then obviously also in practice, we then compare the valuation that we've done for the company. We compare that to the market value using the current price that the share is being traded at, and then we compare to see, okay, is the current market price overvalued or undervalued? Okay, so that's the first thing to draw your attention to. Remember, I've told you guys to go into these exam papers, exam sittings with a highlighter, with some other blue pen or green pen to underline, a red pen to circle, something to make notes with it. Really, I know I keep saying it, but I can't tell you how important that is. So you're also then engaging your whole brain with the paper and with the question. When you're not just reading it with your eyes, your brain is going to be nervous and it's going to be jumping around. Personally, I find if I hold a pen or something in my hand and I'm physically engaging with the paper by circling, underlining, highlighting, making little notes on the side, it immediately focuses me on the paper, it focuses me on the question, and it's also very grounding. It kind of helps you to your brain to stop fluttering around in all directions and to just calm down and focus on the question. Also gives you confidence that you're in control and you know what you're doing with a question. Okay, so that's one thing to think about. All right, so let's have a look at the questions then. They've said for 5.1 for 7 marks, which again, and I'm going to remind you again, which is this, I think is it's quite tricky. 7 marks means that they want you to complete this I like my caps on, that they want you to complete this in 7 minutes. So again, when you guys are practicing at home now for the paper on Friday, you are going to time yourself. How long did it take me to do this question? Okay, without looking at the answers, without looking at any solutions, practice the question. How long did it take you to do that question? That's going to give you an idea of how well prepared you are for the exam. All right, so PE ratio. So we all know that PE ratio that we calculated, and remember you calculated PE ratio in second year finance. PE ratio is calculated as the market price of the share divided by the EPS, the earnings per share of the company. So when we are doing a valuation of a company, we don't want to use the current market price of the share as it is currently trading on the stock exchange. We want to actually calculate, given the metrics of the company, what should the market price actually be in terms of all the other metrics. Okay, so because remember, on the stock exchange, there's a lot of sentiment involved, and share prices go up or down depending on what news there is in the market and how interest rates are moving and all sorts of other things. So we want to calculate the fundamentals of the company, and given its latest earnings history, what should the share price be trading at, and that we're basing our value on that. Okay, so we then want to know what PE ratio is appropriate for this company, and we will then work out what the earnings per share is for this company. And then once we know back over here, once we know those two things, we can then work out the price. The price is then going to be equal to PE ratio multiplied by the EPS. And that will give us the theoretical price per share that the shares should be trading at. Okay, does that make sense? So this is what you've got to kind of like really know your work to this kind of depth, that you understand that this is what we are doing when we are valuing a company. Okay, so now let's go. So basically this is where we're going. PE ratio is equal to the market price divided by the EPS. So let's go and see what information we have got. We've got the number of ordinary shares. We've got the current market price, ex-dividend. Ex-dividend means after the last dividend has been paid. So the latest dividend was 12 Rand. So in other words, 2022, after the dividend was declared, the share is trading at 450 Rand a share. The proposed retention ratio for 2022 is 40%. So what is the retention ratio? Retention ratio means out of the profits of the company, so from profits, how much will be retained? In other words, as our retained earnings. So they're saying 40% of the total earnings of the company will be retained. Okay, retention will be retained. So what does that mean in terms of what does that mean for the other 60%? If 40% is going to be retained, then 60% is going to be paid out as the dividend. Okay, this is important that you can make these associations. Remember always, wherever you've got one or two figures, you can always calculate the second or third missing number. So if they've told you that retention or retained earnings is 40%, you know that the dividend payout is 60%. If they tell you that the payout is 60%, you know that retained earnings is 40%. Okay. So they have given us the dividend per share, 12 Rand. So the dividend is then going to be 60% of total earnings, because we've been able to work that out over here. Okay. And if I know what 60% of earnings are, I can then, using maths, work out what 100% of my earnings are. Okay. What else did we need there? All right, I think that's all that we needed from this information. Oh yes, we need one more thing over here, and that's the average industry PE ratio is 12, and they told us here a positive adjustment of 4 needs to be made to the industry average for this company's specific risks. Okay, so that 12 is the industry average. We must increase that, a positive adjustment, increase it by 4 for this company's specific risk. So we then have worked out that the PE ratio for this company is 12 plus 4 equals 16. Okay, so we know what the PE is, 16, and we also now know what the EP is, earnings per share, because we took the dividend of 12 Rand, which is 60%, and we divided it by 60 and times by 100, or other way of saying that is we took 12 and we multiplied it by 100 over 60. That's my 100 over 60. Okay, so let's go. Those are your workings and the things that we're going to be working with. So let's have a look at how this was laid out in the memo. So here's at the top, we first worked out the EPS, 12 Rand dividend divided by 0.6 or multiplied by 100 over 60 gives me my 20 Rand EPS. And I've here worked out the PE ratio is 12 plus 4 is 16. So because PE ratio is equal to price divided by EPS, if I want to know what price is equal to PE times EPS or EPS times PE. Okay, so I now know I've now got my EPS of 20 multiplied by my PE of 16, which gives me an implied, remember this is a theoretical value, implied or theoretical value of one share of 320 Rand. Remember, they asked us to calculate the value of Olympian Limited. So I must take the value of one share and multiply that by the total number of shares in issue. So 320 times 350,000 shares is the value of Olympian Limited is 112 million. Okay. I want to also just bring your attention as a financial management student also to have a look at the way that this answer has been laid out. So apart from the calculations that we've done, when we have written the workings and the answers down in financial management, we never just write numbers down in a long row or underneath each other with no explanation, no indication of what it is that we're working or thinking or the progression of our thought or our calculation. So you can see here, and this is what you must do in the exams to some extent, you must write down here that this is the EPS that you are working. So you're saying EPS equals, and then the workings, 12 divided by 0.6 equals 20. This I wouldn't have written average industry PE, because what we are working out here is the company PE ratio. So I would have just said PE ratio is average plus adjustment, 12 plus 4. And then a little therefore, theoretical value of one share is 320. And underneath that, multiplied by number of shares, and so on. And then therefore, theoretical value of the company is 112 million. Okay. It really, really is important. And when you are looking at your workings, particularly in long questions where quite often you've got to do one calculation and then use the answer to that calculation further down in another part of the question. If you haven't described and labeled your workings like this, when you need to go back and get a number to use somewhere else, you're not going to know what you're looking at, and you won't know what you did, and you'll have to go back and do it all over again to follow what to follow your working, so that you know what it was that you did. So working like this neatly, everything one underneath each other with explanations, descriptions, labeling, very important. Then the second one that they did over here, 5.2, calculate the value of Olympian Limited using the dividend growth model. So the dividend growth model, we know we've got two. It can either be the dividend growth model, which is stable growth, or you've got the variable growth model, where you've got an initial growth period followed by the terminal growth period. So in this information that they've given us here, we've got risk-free, market rate, equity beta. So we already know, as soon as you see that, equity and risk-free and all that kind of thing, as soon as you see that, you know that that's the information that we use when we calculate the CAPM of a company, the capital asset pricing model. And you must also remember that the capital asset pricing model, what that calculates, another word for that is required rate of return. Okay, so that's just an aside for the moment. So what other, so again, analyzing the information they've given us, I know immediately, okay, I've used that already, okay, in my PE ratio calculation. This information here, I'm going to use to calculate CAPM, or that's what it's useful for. And then the other information that they've given me here, I've got the current market price. Okay, so my current market price is PO, or the price at time 0, but that's what it's currently trading at. Dividend per share for 2022. So that means this last dividend, the latest dividend that has already just been paid. So we know when our last dividend is D times 0, or D0, which means the last dividend. Okay, so always put your little variables next to each bit of information. Current market, we know, is price at time 0. They're always going to be helpful for you. Then we've got, we've already used proposed retention ratio, and then what have they given us? My dividend per share for the last 5 years. So I've got 6 years worth of dividends. From 2017 all the way through to 2022, I know what the actual dividend was that has been paid. So using this information here, I can calculate what was the growth percentage over this period of time. Okay. As soon as I've got that history, I can calculate a growth percentage, and it's in your textbooks in Learning Unit 2. Several different methods on how to do that. Okay. So this is how you need to analyze the information given to you in a question. So when you look at this block of information, it's going to be daunting, and you're going to think, oh, how am I ever going to make sense of it all? But you break it down. You must know your work so well that when you look at the information they've given you, you know exactly what you're going to use each of those different parts of information for. Okay. So we're going to dividend growth model. So I've got nothing here about an initial growth percentage and a terminal growth percentage. So I know the dividend growth model that I'm going to use is going to be then my basic dividend growth model, which says that I want D1, sorry, not D1, the value of the company, PO, the value of one share at time 0, which means currently, is going to be equal to D1, which means the next dividend that's going to be paid out, over divided by K minus G. Sorry, I get a bit OCD with these. I want them in small letters, okay? That's our dividend growth model. This little formula is on your formula sheet, but it's an easy one. And if you remember it quickly, remember always just go and check quickly on your formula sheet to make sure that you've got it right. PO, which means the value of one share today, is equal to D1 over K minus G. The next dividend that the company will pay out divided by K. And remember, you're not going to have you will have no key to formulas will be provided. So on your formula sheet, you'll see D1 over K minus G, but you have to know what is D1, what is K, what is G. And you have to have memorized that from the key in the textbook. So we know that, am I going to fit this in underneath here? I don't think so. That I've explained D1, K is equal to the required rate of return, okay, of the investor. Whoever is wanting to pay, whoever wants to know what the price of the share should be, it is the required rate of return of the investor that will be buying one of these shares minus G. And G, when it's just like that, is the growth rate. The growth rate for this company. Okay, so PO equals D1 over K minus G. So that's what we've got to calculate. So PO is what we want to know, the theoretical price per share. Okay, D1 will be able to calculate that by taking the last dividend that was paid out, in other words, D0, and increasing it by whatever the growth percentage is, because that will tell us what the theoretical dividend will be that will be paid out in 2023. So that's how we calculate D1. DO multiplied by 1 plus the growth period. How do we calculate K? So this requires you to remember the key to the formula, that K is equal to the required rate of return, and that it requires you to remember that CAPM is the required rate of that CAPM percentage is the required rate of return of the investor. Those two are one and the same thing, and that we've got the information here to calculate CAPM. So using this information, we can calculate K, and then minus G. Using this information, we can calculate the value for the growth percentage, which, remember, in our time value of money calculations is going to be solving for R in either a present value or future value formula calculation. Okay, so let's go and have a look at the workings for that. So in these workings, and just by the way, this was 14 marks, so that's 14 minutes. So in these workings, we first calculated the value for G. So we already know we're going to take D0, which is the 12 that they've given us, and we want to multiply it by the growth percentage. here they have given you the financial calculator version of solving for R. So the dividend of 12, which is the latest dividend, we put into the future value key on the financial calculator. So 12, you type in 12 on the financial calculator and then press FV. And then we want the oldest dividend. So the oldest dividend 2017, R9.50. And remember always, whenever you're going to enter any amount into the present value key of your financial calculator, you must indicate it as a negative amount. It must have a minus. And the way we do that is on your financial calculator, you type 9.5 and then you press that key on the financial calculator that has got the plus over the minus sign on it. The plus minus, the key that has got plus minus on it. Okay, and then you'll see on the screen of your calculator, it will turn the R9.50 into minus R9.50, and then you press the PV button. So we've programmed 12 into the future value button. We've programmed minus R9.50 into the present value button. And then we want to know the value for N. How many years growth have we got? This is one where the students often get tripped up. Remember, what we want to work out here is how many times did the dividend grow? So the first dividend is R9.50 in 2017, and the latest one is R12 in 2022. So we grew from 2017 to 2018 once, 2018 to 2019 twice, to 2023 to 2021 4, to 2022 5. Okay, so how many times did the dividends grow? The dividend grew 1, 2, 3, 4, 5 times. So 5 is what we will program into N. Okay, N is equal to 5. And then we go comp R and we get 4.78. There are manual ways in which you can solve for R. They're in your textbook in Learning Unit 2, at that section at the end where you've got the alternative uses for your present and future value formulas. And right at the end, there's a specific section in the chapter that says calculating growth rates with I think 3 different methods. So make sure, if you don't have a financial calculator, make sure that you have memorized a method for calculating a growth rate if you are given a set of values over a number of years. Okay, so we know that the growth rate is 4.78. Now we've calculated, we've got comp R, but remember G stands for percentage, growth percentage, and R is a percentage. It's our percentage value that we're going to grow by. And then we're going to calculate cost of equity. We do the CAPM calculation. So there they've given us all the information we need. Remember, our CAPM is the risk-free rate of return plus the beta of the company multiplied by, in brackets, the market rate minus the risk-free rate. All of this information was given to us. If we go back to this information, the risk-free rate of return is R6.50 plus the beta of the company. And they told us that the equity beta, so the beta of this company, is 2.5 times the market beta. So that requires you to know what is the market beta. If you don't know that, you have got no way of calculating the company's beta, because you've got to take market beta times 2.5. So remember, market beta is always is 1. It's like the base starting point. Market beta is 1. and then we measure our company that we're examining, we measure their beta either +1 or -1. So this one is 2.5 times the market beta. If they don't say anything, like here they haven't mentioned anything, then we assume that it's correlated with the market beta. In other words, if the market return increases, then our company's return will also increase, so it will also be a plus. So there we have indicated it as 1, which is the market beta, times 2.5, and then in brackets return of the market minus the risk-free rate. And that gives us a CAPM, i.e. required rate of return, i.e. the value for K in our dividend growth formula of 30.25. So now we can calculate the value of the company. D1 over K minus G. 12, which is D0, multiplied by, we're going to grow it by the 4.78. Just get this on here nicely. There we go. We're going to grow 12. So 12 times 1.0478. That will give us next year's dividend, D1 over K, 30.25. Just remember to keep your decimals all the same. So 0.3025 minus 0.0478 gives us a value for 1 share of 49.37 rand. And then again, just like we did above here, we then multiply the value of 1 share by the 350,000 shares in issue, and that gives us then the value for the company in this case of 17,279,500. Okay. So as I said, this question is in your textbooks, but I know it is quite a tricky question to understand when you're first looking at it. If it hasn't been worked through and all the different steps explained to you. So this particular question, I just wanted to go through with you guys so that you had all of those various bits and pieces. It is a popular question. It might come up, or parts of the similar sections of this question might come up in the exam. As I say, we've got to be prepared for everything. What else? Okay, so that's the 14 marks, and then for 4 marks in your report, discuss. So this is a theory question. Any 2 potential pitfalls that your team needs to take into account before making a final decision based on the dividend growth model. So what they're asking you for here from your textbook is the disadvantages of the dividend growth model. In your textbook, you've got advantages and disadvantages. So always read those are all learning objectives. So always make sure you know for all of those, wherever they've got it in your textbook, advantages, disadvantages, make sure you have memorized them. They come up time and time again in the question papers, worded in a way something similar to this. Remember, you are third years. They're not going to give a right question that says, please name 2 disadvantages of the dividend growth model. They ask you that in first year. In third year, you will be asked in this way, discuss any 2 potential pitfalls that you need to take into account. So you must be able to interpret this as saying, yes, so that means what are some of the potential disadvantages to the model, and that would then obviously be a pitfall, a potential pitfall. Question 5.4 also I'm not going to go through in detail. This is comes exactly out of your one of your assignments, where you also had to take the free cash flow formula. Remember, not the free cash flow valuation formula, but the free cash flow formula, and solve for one of the variables in the formula. So in this question, they've given us the free cash flow and depreciation and other stuff, and we had to solve for the net capital expenditure. I think this was actually the same question as in your assignment. You also had to solve for CapEx. Okay, so you're familiar with that one already. Then in question 6 in this paper, I'm not going to go over this because, again, we've been over this. I've done 2 of these questions already, which are these long questions where they give you all the information for an investment into new machinery or equipment that the company is doing, and then they're going to ask you initial investment, taxable income, working capital requirement, and that type of thing, or cash flows from the cash flows that are going to be generated by the machine and all of that sort of thing. I had a look through this question. There's not much that's different. They describe the equipment, etc. Remember, you're watching out for things like inflation rates and increases. And when you look at inflation rates and increases, you must make sure you understand from which year that increase or inflation or decrease takes place, so that you apply the increase or the decrease in the correct column. Remember, you're going to have one column for each year's operating cash flows. So again, take care of your wording. Okay, there's the cost information. We are going to sell this machine for 800,000 at the end of the project. I'll go over that section. It's the only question that I think we haven't done before. The output will be for year 1, expected increase, etc., year 2 and year 3. Make sure you apply these percentages correctly. So 50,000 will go under year 1 column. Then year 2's column will be 50,000 with a 20% increase. Year's 3 column will be year 2's amount with a 15% increase on that. Annual inflation, that's economic inflation, 8% per annum for the next 3 years. Current selling price. So this is important. Where they say current selling price, that is also at time 0, okay, or year 0. Our columns are going to be year 1, year 2, and year 3. Okay, so that means when you want a selling price to use in year 1, you are going to take the current selling price, which is the selling price at year 0, and you're going to increase it at 12% per annum to get to year 1 selling price. Okay, when they say current selling price, that does not mean you take that amount and use it in year 1. Year 1 is in the future. Remember, we are evaluating this project now at time 0, and we want to know if in the next 3 years we should purchase this machine and operate with it. Current, again, variable costs. So that also means these variable costs of R3.50 here is the variable cost at year 0. So are expected to increase at half of the annual inflation rate, which means half of 8% at 4% for each of the years that the machine is in operation. So R3.50 plus 4% will be year 1. Year 1's amount plus another 4% will be year 2, and so on. Okay. Make sure you understand that. This is where the students lose the marks. They don't apply these percentages in the correct years. And then, of course, there's a lot that then is wrong. Additional working capital requirement. This, I think, is similar to what you've seen before. Management have indicated that based on the historic trends of the company, the working capital requirement at the start of each year will equate to approximately 10% of the combined total total variable and total fixed overheads for the year. Okay, so that means for each of the 3 years, you have to calculate the rand value of the total variable costs for the number of units that will be made in that year, plus the fixed overheads for that year, then calculate 10% of that amount, and that is the required working capital requirement at the start of that particular year. And then remember, for your working capital requirement, you always, and I'll show you in a minute, you do that table showing the lump sum of working capital required at year 0 at the start of the project, and then the incremental increase or decrease at the beginning of each subsequent year of the project. Fixed overheads, 100,000 for year 1. So there they have told us it's 100,000 in year 1. So they didn't say the current fixed costs are 100,000. They've given us year 1. This is, you've got to look for these. You've got to expect these workings and look for them. Which year are they giving me this information for, and what do I need to do with it? And then expect it to increase at the rate of inflation for the following 2 years. So 100,000 will be in the year 1 column, and then year 2 and year 3, you will increase by 8%. You can also see how important in a couple of places they've referred to the inflation rate. If you did not take your highlighter while you were doing your read through and highlight annual inflation rate when you read it, so that your eye can quickly go back and find this, so that you can do these other calculations where you need to use the inflation rate, you are you're wasting time. Remember, the purpose of that is to save you time and to prevent you from making an error by picking up the wrong percentage, because quite often they have 2 or 3 different increase or decrease percentages in the question, and you often find that students will look quickly for a percentage and they'll see a percentage and use it, and it won't be inflation rate, it'll be something else. Okay, so that's why it is an important strategy to use your underlining, highlighting, etc. Current corporate tax rate, capital gains, capital allowance for this machine. And here again, I've mentioned this before, tax is paid annually in arrears. And I did do a full explanation of this in one of the 2 work-throughs that I did. So remember, when they say in arrears, you first have to calculate the taxable income for year 1, year 2, and year 3, so that you can calculate the tax liability that arises from year 1's operations. But from a cash flow point of view, my tax liability from year 1's operations is going to be paid out of my bank account in year 2. So if you had to do a cash flow calculation on your row where it came to tax cash flow, under year 1 you would have 0. Under year 2 you would have year 1's tax liability. Under year 3, year 2's tax liability, and you would have to have a year 4 column that you could put year 3's tax liability under that column. Ignore that, and cost of capital is 9%. So if you've got to do any present valuing, that's what we would use that 9% for. Okay, so again, you must always know, why did they give me that information? What would I use it for? And don't just use it because they've given it to you. Sometimes you need it and sometimes you don't need it. So don't also assume that every single amount and percentage in a question you need to use somewhere. Okay. Just again, be aware of that. In this one, they wanted us to calculate the working capital requirements for the years that the machine is in operation, calculate the initial investment in the machine. So remember, in your textbooks, you've got all your theory for what is included in the initial investment rand amount. And then we've got our operating years of operating cash flows. And then finally, we've got the terminal cash flow. Calculate the taxable income. So the taxable income for the machine, not cash flow. So remember, they could either ask you to calculate the annual cash flow from the machine, or they can ask you to calculate taxable income. So please make sure you know that they are 2 different things. Taxable income versus cash flow. And make sure you do the correct one. So you can't calculate cash flow without calculating taxable income first, because you need to calculate the annual tax to include in the cash flow. Okay. 16 marks, and then calculate the tax that must be paid on the sale of the machine, if any. So that right at the end of the life of the machine, we're going to sell the machine. What will our tax bill be because of that, if any? And that was for 3 marks. I just wanted to show you, oh, I don't have it here. Where did I put it? Oh, I think I just had this as a written note somewhere. If I can find where I had put it. I went through this paper just as a matter of interest to have a look at all the different theory questions. And this paper had in 5 of the questions, there were theory, and there was 24 marks of theory out of the 180 marks of the paper. It was 13% of this particular paper that was theory questions. So remember, if you haven't memorized your theory and know those that information, the discuss, etc., explain, discuss, whatever, it's 13% of the paper that you are unable to even attempt to answer. So make sure that you do know your theory. This question here that I'm showing is just these, the pitfalls to the dividend growth model, which obviously is straight out of the textbook, disadvantages of the dividend growth model. This is that calculation of the net capital expenditure. Your free cash flow formula is on the formula sheet, but the free cash flow valuation formula is not on the formula sheet. I did already show you in one of the previous videos a cheat that if they do ask for free cash flow valuation, you can use. I'll show you in a minute on the formula sheet. I think it is on the scan. You can use the bond valuation formula as a substitute for the free cash flow valuation model formula. They basically, you're doing the same calculation. And so they have explained that already. So this was then the calculation for the working capital. So remember this one, they said working capital is 10% of the total of the variable costs plus the fixed costs for each year. So you had to calculate the variable cost for each year, which means you had to calculate how many units you were going to make each year, because variable cost was given to us as a variable cost per unit. You also had to inflate the variable cost correctly. So 350 Rand was the current cost, and it had to be inflated at 4% in year 1, 2, and 3, giving us a total variable cost multiplied by the number of units, total variable cost, total fixed cost. Again, you had to take fixed cost from year 1 that then increased by 8% in year 2 and year 3. Add total variable plus total fixed to give us our total costs, which we will then multiply by 10% to get the grand total of the working capital required at the beginning of each year. Then we remember at the top here are our years. So at time 0, which is now, today, current, the present, or i.e. at the beginning of year 1, and then year 1, year 2, year 3, we always assume that those cash flows take place during the year and are the totals that have taken place by the end of each of these years. So the beginning of each year, so 10% of year 1's total is what we require at the beginning of year 1. In other words, today at time 0, day 1 of year 1. And then the difference between year 1's costs and year 2's costs that is an increase. So this will also be a cash outflow. Take note that that must be indicated in brackets because the initial investment in working capital is a cash outflow. So you must indicate with all of these cash flows, is it a cash outflow or cash inflow? And then in year 3, it also increases from the second year. So the difference between the total we require in year 3 and the total that we've already got is going to be the increase that we have to invest at the beginning of year 3. And then at the end of year 3, the full amount that we then have invested in working capital will be released back into the cash flow of the company. So that is then no brackets. Okay. What was 6.2? Initial investment in the machine, the cash cost of the new machine plus the delivery costs plus import duties. Remember from your accounting, it is the cost plus any directly attributable costs that we include, and then initial cost of the project of the machine, we include working capital requirement in that. That's in your textbooks in that section, initial cost of a project. So our total initial investment, if we were to undertake this project, is all of those amounts added together. But just remember that when it comes to working out the capital allowance for each year of the machine, that is only going to be worked out on the accounting asset value of the machine, which will not include the working capital requirement. So when it comes to that, we will only include the cost of the new machine, the delivery costs, and the import duties, because those are the directly attributable costs that we must capitalize when we purchase that machine. So just those 3 amounts added together is what we will use when we work out the capital allowance. And then they asked us for taxable income. So again, we are going to work out the contribution. So sales minus cost of sales basically equals gross profit contribution. So this is per unit times number of units is our total contribution. So gross profit minus all of our overheads gives us our net contribution, which they haven't got a subtotal in here. I like to put in subtotals to follow myself as to what I'm doing. And then we are, because this is taxable income, we are allowed to deduct the capital allowance for each year of the machine to reduce our income so that the taxable income is after deducting the capital allowance. So take note what I told you above here about those 3 costs that would only be included in working out the depreciable value of the machine, and 40% in year 1 and 20% in year 2 and 3. And then that, subtract that, and that gives you the taxable income. And that was what they asked. So we stopped there because they only asked for the taxable income. They didn't ask for the actual tax. Always read carefully so you're not wasting time calculating things that they didn't ask for. And then 6.4 was calculate the tax to be paid on the sale of the machine, if any. So just to remind you here, they said that the machine will cost 2,750. Additional 5,250 for delivery and installation, as well as import duties, which were all capitalized costs. And at the end of the life, we are selling it for 800,000. So this 3,825 is the capitalized value of the machine, which is those 3 amounts added together, the cost plus delivery plus duties. Remember, this is at the end of year 3. So at the end of year 3, the tax value, carrying tax value of the machine will be the 3825 minus these 3 years worth of tax allowance. So there is still 20%, because remember tax allowance is 40, 20, 20, and in year 4 they are still allowed, they've got the other 20% balance that is still going to be allowed from a tax point of view. So the carrying value from a tax point of view of the machine is still 765,000, which is 20% of its initial value. We haven't yet depreciated or claimed the tax allowance for that last 20%. The selling price, in other words, our income before tax, is 800,000. We are allowed to deduct from that 800,000 the 765, which we have not yet claimed as a tax allowance. So that leaves 165,000 of that 800,000 that we sold it for as the taxable amount. So 165,000 multiplied by 28%, which is the tax rate, means that the tax that they would have to pay is 46,200. So this is an example of where the memo had an error in it, because the question said calculate the tax to be paid, which means that we had to calculate the taxable amount multiplied by 28%, and 46,200 is the amount of tax to be paid on that machine. And then from a capital gains point of view, just to remind you, there is never any capital gains on a machine when you sell it for less than what you paid for it. So, or what its initial cost was. So its initial cost was 3.825 million. We only sold it for 800,000, which is less than its initial cost. So there is no capital gain. So we know no capital gains because the selling price is less than the original cost of the asset. If we had have sold it for 4 million rand, then for the recoupment calculation, we would have used 3825 as the selling price minus the tax base, and what's left over would then be the recoupment, taxable recoupment. And then what did I say? If we sold it for 4 million, the difference between the 4 million and the 3825 is then the taxable capital gain, which we must then multiply by, I think they said there was an 80% inclusion rate, multiply the difference between the 4 million and the 3825, multiply that by 80%, and that's the taxable portion of the capital gain. That's if we had have sold it for 4 million and not 800,000. Okay. So no capital gain if the selling price is less than what you paid for it. And if you sold it for more than you paid for it initially, you will have a taxable capital gain as well as your recoupment, sorry. Oh, this is where I made those notes. Okay, so here 24 marks of the paper was theory, and that equated to 13% of this paper that was theory. So just make sure you can't afford to throw those marks away. So and honestly, guys, you know, learning the theory, if you know the theory, it helps you to understand the calculations. That's why we do the theory first and then the calculations, because if we don't understand what we're doing or why we're doing it, then we're just doing maths like a parrot, and we aren't able to apply different scenarios that we are given to our various formulas, etc. So it is important from lots of different points of view. Okay, guys, so that's what I wanted to just cover quickly now today before your exam. So that this is the last recording I'll be making before your exam, and then I'll obviously be looking out for questions that anybody has got today and tomorrow. So all the very, very best of luck, guys. I'll be holding thumbs for a nice paper, and remember, just stay calm, stay focused, and just make sure that you keep track of the time so that you finish as much of the paper as possible. All right, guys, I'll chat you guys again soon, and have very good luck for the paper. Thanks, guys. Bye.